Good evening, everyone. Thank you for joining. We've got folks still zooming in, and we're thankful for the opportunity to do this through our tools that we have access to. Certainly, we were hoping to do this in person tonight, and I was really looking forward to that. I know Kimberly worked really hard to put this together at the Maple Chase Country Club, but then we had the historic ice storm. Is what I was told it was. So yeah, hopefully it was not too bad at your home. I know a lot of folks had a lot of power outages, and there were certainly some complications with that. So we decided to play it safe and do this on Zoom. And we're really thankful to have Nicholas Johnson with JP Morgan. I'm going to let Kimberly kick things off with introductions and just some other opening comments. Take it away, Kimberly.
This is kind of cool. I'm looking back. I don't know that I've actually sat up in my kitchen since the years of COVID when we came to everyone weekly for updates and wanted to stay, active in front of everybody and let them know how everything was doing. So it's kind of nice that we can remember how to, keep things rolling even when there's a pivot in place. But I appreciate Nick being able to change things around and do it this way versus driving all the way to Winston-Salem. Thank you very much. Uh, it is our honor to have Nick Johnson, who's managing director and client advisor covering North Carolina. He's been with JP Morgan for 16 years, and he and his wife Haley live in Charlotte with their 12-year-old daughter Emma and their 4-year-old son Graham. So I'm curious, what did Charlotte get? Did you get a lot of just rain, or was there this nasty ice?
I call it a concoction. We got a little bit of snow, some flurries. We got freezing rain. We got some pellet looking thing. Um, we got ice. We got everything. And it all melted as soon as the temperature got up to 40 degrees yesterday.
Little smattering of everything.
That's
And
it.
then, in case you are joining us for the first time, welcome. We try to do these informative seminars every 3 or 4 months. And at the beginning of every year, we kick it off with a trusted partner like JP Morgan to come in and give us what their views are and how that kind of meshes with what we do. So if you do know him, there's Matt. And if you don't know him, this is Matt Hearn. He is a partner at Cannon Wealth Management Services. Matt's been in the industry for over 23 years, but he started his career in 2002, and he started out as a high school teacher. And let me tell you, there are definitely shades of that still run through him to this day. So he definitely has a teacher's heart, right along with having a servant's heart. But that's one of the things I appreciate about him the most. And again, we're going to have a time after this is said and done to have Q&A. If you look at the bottom of your screen, you should see the one that is 1, 2, 3, 4, 5 over Q&A. If you have any questions throughout, I'm going to be monitoring that. And we've set aside some time as this wraps up to get those questions answered. And if I have covered everything, I'm going to go ahead and go off screen and let these two fine gentlemen take it away.
Thank you, Kimberly.
Ready for me, Matt?
Yeah, I think we'll go ahead and kick things off with your outlook from JP Morgan, and I'm excited to hear that presentation, and then I'll wrap things up. Yep.
Okay. I'm going to share my screen for all of you that can um, view it right now. Let's see if I can make this happen. Everybody see that? Okay, perfect. So I'll try to take the next 30 minutes here um, to discuss a lot. And then I think Matt's going to bring it back home and really discuss it from a higher level. Um, this is not meant to be a predictor of what is going to happen in markets this year. If anybody tells you they know what's going to happen, please run from them. This is just meant to give you clarity and perspective. And that is really hard to get in today's news media age. Our news media, whether we like it or not, is very biased, one way or the other. It's not always in our best interest. It is not meant to calm us down and keep us patient and on the right route with our plan. It's meant to excite us and make us do irrational things in most instances. So hopefully, this is going to be the opposite. Some of this stuff is going to be a little heavy. It's going to be a little deep. I don't want to just, shield you with a rainbow and butterfly presentation that everything's fine and just invest and set and forget it, because I don't think that's fair. So if there's something that you don't understand, I think you can raise a hand. We can address it at the end, jot it down, and we'll make sure that I make sense of it to you. But let me start here. Probably the most popular sitcom in history was a show called Seinfeld. You probably know the set of Seinfeld. It was supposed to look like an 800 square foot apartment. It was actually a lot smaller than that. It was half that size in reality, which meant the cast had to get really creative with how they moved around, how they performed. And those tight spaces pushed them to try new things at all times. So Elaine, for instance, she would come in instead of sitting on the couch for the dialogue, she would go into the refrigerator and make it look a little bit more interesting. Um, when you don't have a ton of resources, it can actually spark some pretty clever ideas. And it's true in TV, but you see it in businesses too. Um, Airbnb, Uber, Venmo, Square, Palantir, Tesla, all of those companies were started during really bad periods in our economy, downright economic recessions. And some of the best companies that we live with, came out of really bad times. They found ways to come up with inventive ways to make something new work. And for investing, I think there's something to actually be said for just embracing your own limits and instead of just wishing you had what everybody else had. So we all have freedom as individual investors in this day and age to be really creative with the strategies that we invest in. We don't have to just copy what the huge institutions do. They've got different goals. Um, we've had a really long stretch where the economy and the stock market has done really well. We've had plenty of pullbacks, but history shows these good times they don't last forever. We get calm periods and years of 20 plus returns, and then that sets the stage for the next shakeup. So, at this point, when times are bad, the stock market is down. You don't want to be dwelling on that. You want to be thinking about, what could cause the stock market to go up. When things are really good, we've had three phenomenal years of returns in the S&P 500, 24%, 25%, and then last year 17%. We're at all-time highs. I want to be thinking about what could go wrong in this instance. And it's not to bring you down. It's not to say anything is going to go wrong, but that's the way you should be thinking about your portfolio. So might be a good idea to, just simply pay attention to what we can actually control. Get ready to jump on opportunities when things get inevitably rocky. That's not a time to panic. Start thinking about shifting investments into spots that are a little out of favor, that haven't done so well over the last couple of years, perhaps before the next downturn hits. Above all, just keep your cool. It really matters when markets, get choppy. And if you're ready, because you've built your playbook when things are really calm, you'll be in much better shape, if a storm actually comes. On this chart, we're just looking at asset class returns. So the best performing asset classes up top, worst down below, and then on the far left, you'll see 15 years of annualized returns. That green box right there is the S&P 500. It has returned 14% annualized over the last 15 years. An asset allocation portfolio, 60/40 stock bonds, has done almost 7%. You've doubled your money and just a very balanced portfolio in about a decade, every decade, really. The S&P has done 15% over the last 5 years. If we look, last year, finally the tides turned a little bit, and things like international equities did twice what the U.S. S&P 500 did. An asset allocation portfolio, 60 stock, 40 bond, did almost 16% last year. That's phenomenal for a balanced portfolio. It's not supposed to do that good. That is double our long-term capital market assumptions. All right. Now we've had in the last 5 years, we've had three 20% drawdowns along the way, including COVID. So the power of staying invested is just so critical. But now for me, I'm thinking, well, what do we do with these excess returns if we've been invested through this the entire time? We'll talk about that. Base case for 2026. I think we probably see another year that's similar to 2025. Maybe a 10 to 15% pullback in markets. We've got a new Fed chair coming in May. We've got a lot of geopolitical issues. We've got a lot of divisiveness in this country. We've got an AI boom. Is it a bubble? Will it continue? There's a lot of things that could drive markets down at this level, or maybe people are just profit taking. But despite that 10 to 15% pullback, I think markets probably finish higher by year end. So it's not bearish, it's just reality. What do I mean by that? If you're looking at this chart, we call this our measles chart. The gray bars represent the S&P 500 stock market year-end return, and then the measles represent intra-year pullback. So from top to bottom, how far did that market pull back? And I just said a 10 to 15% pullback, but we probably finished the year higher. It's not a guess, it's just history. If you look at this chart, 76% of the time, markets finish higher by year end, and yet every single year on average, you get about a 14% pullback. So that's to be expected. It's just what the market normally delivers. Volatility is really the price of admission. Now, we need to talk a little bit about what I think the most important narrative is going into this year. And on this chart, we're just showing you economic growth. All right, those numbers are how much the economy grew every quarter or didn't grow every quarter since 2022. And then the colors are just the components of our economy. All right, and there's four big ones. It's consumption. That's 68% of the economy, what you and I spend, consume. And in America and the US, you can just ask my wife. We consume when we're happy. We consume when we're sad. It doesn't matter. And then there's government spending. That's about 20%. Residential, things like housing and everything that goes into that. And then there's business fixed investment. I'm going to walk through all of them, but fixed investment is by far the most critical moving into this year. And we'll talk about why. But for consumption, all right, again, it's 68% of our economy is driven by us consuming. We don't make anything anymore. Trump 2.0 is trying to change that by bringing back manufacturing. We'll see how that goes. But for the most part, we're just a services economy that consumes and spends money, and everything is made elsewhere. But the story lately on consumption has been this K-shaped economy, right? Where artificial intelligence, AI-driven investment has helped to boost economic growth, but lots of other parts of the economy are really struggling. And that's left this weird gap where financial markets keep climbing while, regular folks just aren't feeling good. And that's why consumer confidence is just absolutely in the dumps. That's why we've got a very divisive country. We elected a communist mayor in New York City because people just don't think they can make it in perhaps a capitalist society. So this K shape plays out where you've got a group of Americans that are doing quite well, those that own stocks, those that own houses, and you've got a group that just can't seem to get out. So as this K shape plays out, GDP really doesn't really move with the job market the way that it used to. These days, it's more focused on asset markets and overall wealth. So it used to be the economy drives the stock market. Today, the stock market drives the economy. We will not have a recession unless the stock market significantly pulls back, which is rare. That's how financialized we are as a society. We do expect this gap between the winners and so-called the laggers, the K-shape, to start closing a bit. That's good. You want that, especially with the labor market looking stronger. So for 2025, we saw not a lot of hiring, but not a lot of firing. I think in 2026, we will see more hiring and still less firing. In 2025, I think companies were just plagued by tariffs and a lot of uncertainty, and they really didn't want to bring any new staff. Not to mention what AI is going to do. Now they're realizing we've got to continue to hire for productivity reasons. So I think you'll see hiring demand bounce back. Odds for a recession, they sit around 20%. The lowest that we go is 15%. We always have odds at 15%. So if we're at 20, that is really, really good odds that we're not going to have a recession. Number two, government spending, 20% of the economy, our economy. Everything going on overseas, all right? Venezuela, the talk about Greenland, Davos last week with Europe. Governments are getting more and more involved in their economies. They're scaling back towards more populism and isolationism. We are moving away from globalization right now. At least this administration's admitting globalization did not work. It gutted an entire middle class. And we need to, for security reasons, bring that middle class back, bring manufacturing back, start making stuff in this country as opposed to just consuming it. So in order to do that, the government is spending. That spending used to swing around a lot, but since 2022, budgets have been running much deeper in the red. That tells you they're more willing to use spending as a lever to shape economic outcomes, and most of that support is targeted at very strategic industries. So specific sectors are getting a big boost. Where do you want to invest? You want to invest where the government is putting money. All right. Now, we're also going to see the big, beautiful bill in action in 2026. Please do not listen to politicians. Republicans are awful at messaging, and some Democrats are just outright lying. Bernie Sanders and Elizabeth Warren are saying that this is a tax cut for the rich. It is the exact opposite. This will end up being a tax hike on the rich. This will be a tax cut for the middle class and the lower middle class. You're going to get bigger than usual tax refunds for people and businesses, somewhere between 500 and 100 billion. That'll be about a 0.25% of economic growth because of this. That, alongside with easier regulations and easier financial conditions, should mean this economy runs pretty hot. All right. And that's what the Trump 2.0 administration is trying to do. Now, on to the most important part, which is business spending. All right. That is a contributor to economic growth. It's only 13%, but in this instance, I think it's the most important. A lot of this investment money has been coming from deficits. All right. Really, since COVID, a lot of public spending. We've been running huge, huge wartime deficits in this country. And then from the Fed as well. High deficits aren't going away, so that cash is flowing into the private sector. Companies are making huge bets on things like AI and infrastructure. We have massive onshoring that's starting to pick up. The key is the private sector should really be doing the financing, right? That means banks are extending credit, companies are selling their own bonds. For example, Oracle needs to build data centers, so investors lend them money. Then Oracle goes out and uses that money to buy energy, construction workers, semiconductors, and so on. And then all this spending ends up as someone else's income or savings, which eventually helps finance the original debt. It circles around, but there's always a lag. And right now, there's a lot of borrowing happening. There's a lot of spending happening, but it takes a while before that spending loops back into savings and really shows up in the data. That transition, where we are right now, can sometimes be rough on asset prices. All right. Now, if getting financing keeps getting pricier or it doesn't pay off, you'll start to see investors just stop investing in this stuff. So a few big questions. Number one is, can the Treasury soak up all of the new printing with the deficit at 6%, twice what it normally should be? Can the bond and equity market handle all the financing for this spending? And then foreign investment is tricky. We've got overseas investors are actually selling their U.S. treasuries to put money into projects. Can that selling be absorbed? Who's going to buy that? And if nobody buys it, then interest rates go up. If all these things line up without causing big price swings, mainly in the bond market, we will run with a very hot economy. And that's what our Treasury Secretary Scott Bessent is trying to do. But really, that's at the heart of how things are working right now. So consumers holding up pretty well. Government is still spending. Most of the action, again, that we want to watch is on the investment side. All right. Now we think about AI, which I'll get into. Investments were mostly funded out of free cash flow, which is much different than the dot-com era of the 90s. Companies locked in super low rates over the last, 5 years. But we're in a bit of a transition. All right. Big promises are being made, and they only get funded if the return is big enough. Again, if financing gets too expensive, a lot won't be funded, and that basically means things slow down, and there's where you see yourself in economic troubles. So far, that's not the case. Now, nobody knows how this AI push is going to play out, but whatever happens, it has to deliver a return. How much, where it's coming from, does AI grow economic growth, or does it just shift pieces of the pie around? That matters a lot because you're going to have winners and losers if that's the case. But if AI or any other major investment theme right now, it has to make money, and that depends on how expensive the financing is and how well the real economy holds up. That is why we are so, enthralled with watching fixed investment. Um, On to inflation just briefly here. You can see inflation peaked at 9% year over year in June of 2022. It's now come down to 2.7%. Look, prices are not going down unless we have a recession or a depression. And nobody wants that because that means people lose their jobs. So don't listen to politicians when they promise to cut prices in half. I know that's going to be a huge thing during the midterms. The Democrats are going to say, well, look at Trump, our prices down, blah, 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 blah. And Trump's going to continue to argue he can bring prices down. He can bring oil down, but something like a can of soda, which used to be $3, after COVID and all the money printing, it went to $6. It is not going back down to $3 again, unless we have a recession. It's just going to go up a lot slower now that inflation is growing at a slower rate. It's at 2.7%. JP Morgan thinks at best inflation will grow at 2.3, 2.5%. At worst, maybe 2.9%. What does that mean? You have to at least get your money growing at 3%. If your money's not growing at 3%, which it is not in a CD, excuse me, might in a CD, it is not in a savings account, you are losing your purchasing power. All right. Now, we don't really see inflation as a big threat for most investors. Labor, housing, energy all seem pretty subdued. Electricity prices climbed 7% year over year, but that's only like 1% of the inflation basket. Um, we wouldn't really be buying longer duration bonds like 20-year bonds. You need much higher yields if you're going to, make that worthwhile. But for the most part, we don't see inflation as much of an issue. Midterm, what is our view on this policy uncertainty? Let's talk about kind of the midterms, and I'll talk about the Fed. We'll talk about AI, and I'll wrap this up. But since the 1930s, and ignore this chart, the incumbent party has lost seats in Congress during the midterms in all but three of votes. So, the midterm is usually the least positive of the four presidential years for U.S. equities. However, if expectations are met for a more divided Congress or reduced political uncertainty, which I think is very likely, that will benefit U.S. equities. Now, I think a lot of this again will be on affordability. The main levers that can be pulled, tariffs, housing policy, and stimulus checks are being thrown out there for whatever reason. Tariffs, 70% that the Supreme Court actually rules the International Emergency Powers Act illegal. And in that case, Trump 2.0 could choose whether to replace those tariffs using different authorizations. He'd probably wait till after the midterms, or, you might see some things like tariffs on coffee from South America. I think will be relieved. That will ease consumer inflation and things like coffee. So he can control the price in certain instances from a tariff standpoint. The tariffs, by the way, should be used as a negotiating tool to orchestrate better trade and not as a way to bring in revenues to replace an income tax. I would love to see the income tax go away, but that's not really what we're trying to do with tariffs right now. It's meant to be better trade policy. Housing, the White House ordered Fannie and Freddie to buy $200 billion of mortgage bonds to lower rates. They did that a couple weeks ago. It helped. You've now got a sub 6 mortgage rate. I think you'll see further easing of bank regulatory ratios. That'll reduce treasury volatility, help compress mortgage spreads as well. The stimulus checks, I don't get it. It's possible, but it's going to, there's not a lot of momentum in Congress for that. So a divided government should cut off some tail risk to government policy and support risk markets. As far as the Fed and what the Fed is going to do, this is just looking at the Fed funds rate. You can see it went from 0 all the way up to 5.25 in the 2022 timeframe. It now has come down to about 3.63%. The green and blue lines are just predictions by the Fed and the futures market. I think we get down to about 3.25 by mid-year. Might go lower if things start looking weaker. And right now, Rick Reeder has the best chance to replace Jay Powell as our Fed chairman, and that's pretty good for markets. Markets would like to see Reeder. He is relatively dovish with Fed fund policy, meaning he would bring rates down lower. Um, but he still is fairly independent in himself as far as his relationship with Donald Trump. I think he would push back a little bit more as opposed to some of the other Fed chair nominees. Um, Ultimately, if you want to understand the market, you have to understand AI, artificial intelligence. It is a renaissance. Much like the Industrial Revolution, it's that big. Again, after a correction, you ask what could go right. When markets are highly concentrated at all-time highs, what could go wrong? And if we look at the top 10 companies by market cap by decade, this is crazy. I mean, if you look at just the top 10 companies right now, we went from a market cap of the top 10 companies around 3 trillion to a market cap of 18 trillion just in the last decade. Um, the top 10 companies now represent 20% of developed world equity markets. 20% of world equity markets. That's crazy. Really, 8 companies. You got 42 AI-related S&P stocks. Things like utilities, capital equipment, they drove 65 to 75% of S&P earnings and price returns and CapEx and R&D since 2022. All right. Um, it's huge what is happening right now. Are the valuations justified? They are. They're expensive, but they are justified by tech's superior profitability. Um, Tech free cash flow is 3 times the average S&P 500 company. Um, and valuations are half what they were during the dot-com peak levels back in the early 2000s, late 90s. And we're much less reliant on what we call yuck companies, which is just young, unprofitable companies. So I said, what could go wrong? There's 4 things. All right. Number one, and I'll go quickly, it's a metaverse moment for these hyperscalers. Okay. What is a hyperscaler? That's Alphabet, that's Amazon, that's Meta, Microsoft, Oracle. You can see on the left-hand side of the page the CapEx from these hyperscalers. Um, Back in 2022, even before, we were all supposed to be living in this metaverse, right? You put on your mask and you can buy real estate and go to the beach and vacation and have friends all in this ulterior world. It didn't really come to fruition. All right. So do we have a metaverse moment for some of these big companies that are spending trillions? Possibly. They need to yield equivalent profits to what they're putting in. We haven't seen that yet. You're getting a lot of progress in AI models, improvements in benchmarks like image recognition, coding, math. But there's this high hallucination rate that's still present, which means accuracy. All right, so they're not always right. But adoption rates are really good. You're starting to see labor productivity gains. You're starting to see revenues up, but free cash flows are starting to fall. Cash balances are starting to decline. So we really need to see profitability. Number two, and I think this is the biggest one, is just power generation constraints. Um, if you look at power generation, these data centers that fuel AI, they use 4 to 8% of the U.S. power. They're projected to drive 2/3 of the future load growth. 2/3. Frontier AI training, that power, it doubles yearly. So what is a solution. One is just to kind of bring your own generation. Only 1% of these data centers use on-site power now. 38 expect partial reliance by 2030. Also, there's natural gas. These data centers that fuel AI, 60% reliant on gas through 2030. Um, there's a risk of U.S. gas deficits if natural gas demand tightens. Can we restart nuclear? It would make a lot of sense, but there's only about 2 to 3 plants that have limited restart options. There's cost challenges. Quantum computing is just not there yet. So there is a lot of slack in gas plants and capacity, and we can't burden other consumers and customers with exorbitant power bills, right? And then 3 and 4 have to do with China, mainly that China is able to scale this moat that the U.S. has on AI, mainly because of NVIDIA with their own semiconductor technology. And then number 4 is China and Taiwan. All right. The US is very reliant upon Taiwan. 90% of the advanced chips are made there. US imports a third from Taiwan directly, more through intermediaries. Um, the US wants to be self-sufficient. The goal is 40% of kind of these chips by 2028. I don't think that's going to happen. I think it's going to take longer. We're still going to be relying upon Taiwan. Unfortunately, Taiwan is very vulnerable. They import 90% of their energy, 67% of their food, and China is threatening a blockade, which they could easily do. They dominate local navy, local air. They've got 42 destroyers versus 4 for Taiwan. So we're watching that very carefully. But those are the 4 risks. That's what could go wrong. And that's what we're paying attention to. That's why you want to be diversified in something besides just NVIDIA and Microsoft and all these stocks that have absolutely crushed it. You want to be in other things, international being one of them. Um, so, what we're really thinking about in the fixed income world, you want to be a global fixed income investor. If you look at this chart on the right, don't pay attention to the left necessarily. Over 60% of the opportunity in fixed income exists outside of the US. European bond yields just went up. Now's the time to be buying them. You have yield curves in Europe that look a lot more attractive than they do in the US. In 7 out of 9 main central banks around the world, they are raising interest rates right now. The US and the UK are the only central banks that are lowering at this point in time. So consider a global bond fund, outside of your equities to absorb a lot of that volatility. On the stock side, you want to be thinking about the same thing. All right. Invest internationally. What I'm isolating is that, there is significant pressure for the US dollar to depreciate due to kind of this newfound attractiveness of non-US assets. International assets were up twice as much equities as the US S&P was last year. When Japanese bonds are yielding 15 basis points, like 1/4%, you don't own Japanese stocks. All right. When European bonds are yielding 1% and US bonds are at 2.5%, you wouldn't own European equities. Well, that global risk parity is balanced now, and you can own more of the rest of the world simply because it is less risky than it used to be. Um, but ultimately, you want to own international because number one, it is a hedge against the US dollar. If the US dollar continues to decline, you will make more money in the international equity space than you will in the US. And then it is the ultimate hedge against the US AI trade. All right. You still want to be invested there. But one of the least correlated equity asset classes to US growth and US AI is an international value strategy. That's it. Take some of the excess returns you've gained from the US, put it into an international value strategy. If we see the USAI trade and therefore maybe the S&P start to stumble a little bit because of it, your international value will probably hang in there quite well. If we look last year in the Eurozone, Europe stocks were up 40% last year. 30% of that was currency related and just valuations, meaning stocks just got more expensive. There was very little earnings growth in Europe. It was just a currency and a valuation play. Right now, international developed stocks are still 30% cheaper than the US. All right, so there's still a discount. I think the dollar still weakens as well. Use it for that, and then use it as a hedge against um, USAI as well, which we're seeing way too much in portfolios um, as far as exposure to USAI. And lastly, I'll finish on these two charts. Number one is again, you want to be diversified. For the last 15 years, you could have bought the US S&P and nothing else, and you'd be rich beyond your wildest dreams. You didn't really need to own anything else. Now, I would argue the last year and a half or so, it's revenge of diversification, where you really need to be diversified, not only in equities, but in bonds as well. I just told you, like, you need to be buying bonds across the world. Nobody ever thinks about doing that. They only just buy in the US. Now's the time to be doing that. Why? If we look at the frequency of positive returns across time frames. Look at 1, 3, 5, 10. An all stock portfolio is in gray. A 60-40 stock bond, 60 stock, 40 bond is in green. Just go out 3 years, 91% chance of a balanced portfolio being positive 3 years. Almost 100, you go out 5 to 10 years. All right, which should be your investment horizon if you're investing in stocks. It's not bad in an all stock portfolio. But again, it's not quite as good as a balanced portfolio, which is number one. And then number two, and I'll end with this, we oftentimes hear, well, the stock market's at an all-time high. I don't want to invest now. Let me just sit this out. I'll wait for a pullback, and then I'll get in. Don't do that. Number one, this market could go up another 40% before we see a 10% pullback. And then you're going to get in, and the market's going to be considerably higher, even though we got a pullback. But if you look at the right-hand side of this chart, it's just showing the cumulative returns dating all the way back to 1988 if you invest it at an all-time high in green versus just any other day that wasn't an all-time high. And as you can see, starting with 1 year, 1, 2, 3, 5 years, you actually got a better return investing at an all-time high than you did on any other day. So just because the market is hitting an all-time high doesn't mean you shouldn't be moving into the market. Why? It usually means you've got really good fundamentals, really good technicals, and you've got a lot of momentum with this market. Right now, this market has a lot of momentum. I told you there's a lot of things that could go wrong. That's what we're trying to think about in a market this good. However, don't let that scare you from investing in it. If you don't feel comfortable, if you've got a lump sum of money, you don't want to put it all into a market that's at an all-time high, dollar cost average in. All right, take advantage of the volatility that we're going to see. Again, I told you, I think a 10 to 15% pullback this year, but the market will finish higher by year end. I have no idea when that pullback's going to hit or if it's going to hit. So don't take my word on it. Dollar cost average in, or at least put a lump sum in. You're going to be in good shape 3, 4, 5 years down the road. Much better than you are now, in my opinion. With that, I'll pass it back over to you, Matt. Thanks for listening, everybody. I hope that was helpful. Happy to answer any questions at the end of this.
Great. Thank you so much, Nicholas. We certainly value the insight from JP Morgan and from you, sir. You have been one of our most, I'd say, provocative speakers over the years, coming in and giving us a good round picture, overall global picture of where we are and where JP Morgan believes we're headed. So thank you for that. And we really do appreciate it. It's interesting, I sit in the seat of an independent financial advisor, and we don't have to work with JP Morgan. We don't have to work with, American funds. We don't have to work with Vanguard. We are totally independent. We work for our clients. And so I value the fact that nobody tells us what to buy. We go out and we shop and we look around and we try to find the very best managers and the very best investment firms to work with for our clients. And JP Morgan has been a consistent partner for Cannon Wealth Management over the years. So thank you for that. And it's interesting, as I was preparing this presentation, a lot of the things you just said are exactly what I wrote down. And I did not hear you give that presentation before tonight. So So I'll go ahead and share what I put together here. I won't take nearly the same amount of time. I know we wanted to give plenty of time to
I was
you.
going to go ahead and say too, real
Yeah.
quick. I've already jotted down a couple of questions that were thrown up. You
Okay.
do not have to wait till the end. I am logging in the questions as they come through. So if you have a question, you don't have to wait till the end. I'm keeping track of all of them, and I appreciate
Great.
the two questions I've already gotten.
Yes. Thank you, Kimberly. Appreciate that. So with that said, I'll share. I mean, again, thank you for being here. Sorry we don't have you at the country club, but we'll do that again soon. But good evening, everyone. Every time a new year rolls around, I feel this weird dichotomy. All right, excitement about the new year, but also some nervousness, some unease about what might happen. I'm excited because there's a lot of opportunity out there. It looks like. I mean, as Nicholas alluded to, the economic data looks favorable. I mean, we would say 2026 is we have a bullish stance for 2026. With that said, certainly uneasy and nervous because there are parts of the market that are priced like, somebody put a Ferrari logo on my truck and tripled the price. Not a bad idea if you're trying to sell it, but certainly there are parts of the market that appear to be priced for perfection, so to speak. That tension, opportunity versus risk, defines investing in 2026. Tonight, I want to walk through what's happening in the markets from our perspective at Cannon Wealth Management, and then take a moment to explain why a coordinated fiduciary planning firm like ours matters more than ever. So I'll take a few minutes at the end and share a couple of thoughts there. First, the stock market is expensive by historical standards. Again, Nicholas alluded to this. As of October 29th, 2025, the S&P 500 forward price to earnings ratio stood at about 23.1 times earnings, which basically means you're paying $23.10 for every $1 of expected earnings over the next 12 months. That compares to a 5-year average of 19.9. So 23.1 versus 19.9 is the 5-year average. And then the 10-year average forward PE of 18.6. So just looking at some of the valuations data, just looking at it, taking it for what it is, face value, certainly the stock market appears to be expensive. That doesn't mean it's expensive. It just appears to be expensive. These prices might be justified, but we need to see more productivity, which was already said, and we need to see more profitability. The proof is in the pudding, right? We need to see all of this investment in tech and AI paying off. I met with a client, well, not a client, but a friend recently for lunch, and he's an owner of a company in our area, and he was talking about how they were investing a lot of money in AI, and they're not cell phone company, they're not a computer company, they're not a car company, they're just a manufacturing, food based business. And so it's certainly interesting to see how many businesses are adopting this and how many businesses are spending money on this. And yet, it takes time. And so based on historical norms, the stock market does look expensive, but that doesn't mean it is. Looking at longer term valuation measurements, the Shiller CAPE ratio, which averages inflation and adjusted earnings over 10 years, exceeded 40 during parts of 2025. So that's interesting. It also exceeded 40 back in the dot-com bubble in the year 2000. It also exceeded 40 during the post-pandemic stimulus surge in 2021. So doesn't necessarily signal that we're going into recession or going into a big pullback, but it's just interesting to see the prices are high for stocks. With that said, plain English, the stock market needs to, the earnings need to grow into the valuation. And certainly we will be watching that very, very closely. And that's another reason for diversification in 2026. Fun fact, did you know that long before Silicon Valley or Wall Street, the first real stock market in the modern sense began in Jonathan's Coffee House in London in 1698, where traders met over coffee to buy and sell stock shares. So can you imagine, right? Hey, Nick, meet me at the coffee shop on Monday, and we'll trade some stocks, right? Maybe that's why I love coffee so much. I don't know, but there's a correlation there, I guess. But certainly we've come a long way. There's a lot of data. There's a lot of trading that happens instantaneously, and that can facilitate prices running up, especially when there's potential for something big to happen. And like Nick said, this is another industrial revolution of sorts, with the AI affecting every part of the economy. Number two, market leadership is broadening beyond big tech. So for several years, returns were dominated by the so-called Magnificent Seven. In fact, according to Goldman Sachs, those 7 stocks accounted for more than 50% of the S&P 500's total return in 2023 and 2024. But as of November of 2025, approximately 60% of S&P 500 companies were trading above their 200-day moving average, which means there's a lot of momentum in the S&P 500. There's a lot of stocks that are moving up, and it's a common measurement of market breadth, which can be a good sign for this concentration potentially changing. Right? We're trying to be more diversified in our investors' portfolios with this in mind, because it seems that small caps, mid caps, international are starting to perform better. So a lot of investors do tend to get concentrated. They like certain things. Certain things do well, and so they'll hold on to them and they'll sell what's not working. And so you end up with a concentrated portfolio, and that can be pretty risky. Because as you saw, you might have one area of the market do really well, and then the next year it's at the bottom, and another area is up. So it's really hard to predict. So we like to stay diversified, and diversification seems to be starting to really pay off. Third, international is outperforming the U.S. While the S&P 500 gained approximately 17% in 2025, international markets did even better. Japan up 24%, Europe up about 30%, emerging markets up about 30%. So it's really interesting, because for nearly a decade, people like Nicholas here and other folks would come in and say, look at international, and it was cheap. It was cheap for a long time, and the U.S. markets just continued to run. And it wasn't until I think 2023, maybe 2022. I'm not really sure on that. We can get you that information if you shoot us an email. But we started to add international to our portfolios again in a significant way, and so thankfully it paid off in 2025. And our internal investment committee is always talking about, is it time to add a little bit more? Is it time to make a change? And so this is on our radar, and we are exposed to international, but we do think investors should be, and it's definitely an area where, as Nicholas said, there's value, and it's a good hedge against the AI trade, right? And then number 4, global economy is showing some resilience. In April of 2025, markets sold off sharply due to tariff fears. However, the effective U.S. tariff rate ultimately settled near 11%, which was far below a lot of the fear that was out there. Policy uncertainty peaked in April and then declined. And then, of course, there were some major spending packages. The U.S. passed the big, beautiful bill. And then Germany announced 500 billion euro infrastructure and defense package, which equal to about 12% of their GDP. NATO member countries pledged to raise defense spending towards 5% by 2035. So, there's been some spending internationally and even here in the U.S. from a policy standpoint. And then that a lot of that's going to kick in 2026, by the way. So that could be a catalyst. Fifth, interest rates are starting to fall. Finally, bonds are still paying a good return as of. Let's see, I've got a number here for you. November 30th of 2025, the Bloomberg U.S. Aggregate Bond Index yielded about approximately 4.3%. And so you can still get a good return on bond yields, but certainly that yield may come down as the Fed takes action, and we do think they will lower rates again in 2026. So bonds are a good diversifier again. It used to be that you had this internal struggle when you went with a portfolio of 40% or 20% in bonds because they were paying 2% or sometimes even less. But you knew you needed to own bonds. But today you can get some really good yields in the bond market. And to Nicholas's point, we use the J.P. Morgan Core Plus Bond ETF, which is a fully managed ETF in a lot of our models, and it does have some exposure to international bonds, and so that's part of the strategy that we've been using. Number 6, 2026 may be a year when we have a market pullback. Certainly, history being what it is, that would indicate we're due. But remember, market pullbacks are normal. From 1954 through the year 2025, the S&P 500 experienced a 10% correction about once every 16 months. And a 20% bear market happens about once every 6 years. So pullbacks are normal. They happen. They will happen again. And it's very, very possible that we'll have a pullback of 10% or more in 2026. But that's not a time to panic, right? If you have money on the sidelines, if you have cash on the sidelines, or if you just have a balanced portfolio of stocks and bonds, market pulls back, that's an opportunity to make an adjustment, right? It's an opportunity to take some money out from cash and buy, or it's an opportunity to take some money from bonds and buy stocks. There's all kinds of things you can do in a market dip that can boost long-term outcomes. And of course, that's something that we endeavor to do. Certainly, we're not perfect at it, but if we see a dip in the market, we go in and we look for opportunities in clients' portfolios. Moving quickly, number 7. Oh, go ahead. Yep. Thank you, Kimberly.
No, it's just telling you the time.
Yes, thank you. We'll wrap up here.
That's my job.
Yes, ma'am. And my slide deck is... Okay, number 7. Corporate earnings are driving our outlook. Consensus earnings for 2026 are that emerging markets would be about 17% growth, United States about 14%, and Europe about 11%. This is really the bread and butter, right? This is where the rubber meets the road. Earnings drive the stock market over time, and we do think that earnings will be strong in 2026. There's a lot of reasons for that. And that's not just us. When I survey all the different outlooks and read, I've been reading a lot lately from the different outlooks from our various product partners. This is a common theme, is that corporate earnings are strong and that there's a lot of opportunity there. Artificial intelligence, real profits, real productivity. This was interesting. JP Morgan Chase reported saving about $2 billion annually through AI-driven efficiency. I noticed that Nicholas didn't say that, but JP Morgan is the world's largest bank now, as I understand. So they are certainly looking very hard and investing in AI for productivity growth. Unlike the late 1990s, today's AI leaders generate significant free cash flow, strong balance sheets, and sustainable earnings. We don't think AI is a bubble waiting to pop, but we do think investors should diversify across many sectors. I've already said that, but I just want to wrap that up. And last but not least, coordinating your plan with an advisor that you trust, somebody who only works for you, is more important than ever. I firmly believe that. Most people treat investments, taxes, retirement, insurance, estate planning, all as separate parts of their financial life. A fiduciary investment advisory firm like Camden Wealth is legally required to act in your best interest. We listen to you. We learn who you are. We learn what's important to you. We get to know you. And then as we understand your full financial picture, we make recommendations and give advice that is what we believe to be right for you. So I tell people it's kind of like having a family doctor. Family doctor has a specialist that takes care of the surgery, or has a specialist that takes care of the different needs that you might have. But the family doctor is really the one that knows you, and really the one that all the final consensus of opinions comes back to. So we want to be there for you. If you're not a client, we want to work with you, and we'd love to talk with you. We never charge for a meeting, and so feel free to reach out anytime. With that said, Kimberly, I know we have some questions, and I just want to give you turn it over to you to ask those questions for us. And if you haven't typed your question in yet, please do so. We'll stay as long as we need to. So take it away.
So Nick, can you come back on with us? All right. So I will do the most recent. As healthcare cost to the U.S. now at 18% of the U.S. GDP and likely to continue to rise, what impact is this going to have on the economy and the individual investor?
Yeah, it'll have a big impact. It's a significant drag on the broader economy. It crowds out resources from other sectors. Now, healthcare itself generates a lot of jobs, a lot of innovation. There's probably 16 million people working in healthcare right now, all contributing to economic growth. But the net effect is negative due to inefficiencies, high prices, misallocated spending. So you think high costs lead to lower wages, fewer jobs, worse care. These federal subsidies for health insurance are projected at like 1.8 trillion. And so do we have to raise taxes or borrow more? And what does that do to infrastructure, education, research and development? And then, if we have healthcare inflation, that leads to broader price increases. So that's all the bad stuff. We really need to get this under wrapped. Obviously, there's always an investment opportunity in this, but the way that our healthcare is set up right now, our insurance companies are getting really wealthy. Our care is going down, and our prices are going up. That doesn't make sense at all. We shouldn't be paying more for worse care. The Big Beautiful Bill tried to address some of this. There was a great healthcare plan released in January of 2026. But essentially, there's been some key proposals that need to be enacted. Both sides need to come to an agreement, but these enhanced subsidies expired after 2025. Premiums are going to be kept in check as of right now, which was not good for the healthcare companies, but it's good for the individuals. We need to get subsidies away from the insurers and back to individuals through health savings accounts and direct premium assistance. When you keep giving subsidies to insurance companies, they keep raising the darn price, and that's what we don't seem to understand about this, and that's what was so faulty with the Affordable Care Act. It's like college tuition. Why is college tuition 5 times what it was 20 years ago? It's because we subsidize student loans. So colleges charge whatever they want as long as the government's going to pick up the tab. Um, and that's the same thing with subsidies to insurance companies. They need to be to the individual. We need to fix that. What was not popular on one end is some overhauls with Medicare. Basically, you know, proof of work if you're taking it, and things of that nature, mandatory work requirements, copays, limits on retroactive coverage. So there's a whole lot. I won't bore you with all this, but there's a whole lot that we could be doing. What I'd like to see is a stop subsidizing the insurance companies. It's crushing us. Costs are only going up and care is going down. And those that are wealthy are getting private care. And those that are not are stuck with the system and paying more and more and more, and they can't afford it. They're dropping off. And then when it comes to drug pricing, what our companies have done, and this is something we're trying to stop, and this should be nonpartisan. Uh, but Pfizer, right? They charge us in the price of the pill for all the research and development, which is needed, right? If they're going to develop a new drug. But they'd also like to be global. They'd like to sell that drug in Europe and Australia as well. And the Europeans just said, well, we're not going to pay for your R&D, so we'll just pay the $9 that it costs to make that pill. And you Americans, you can spend $1,000 on that same pill because you're paying for all the R&D. The proposals that are coming out now are saying we want to pay the same rate as the rest of the country pays, or the rest of the world pays, or the rest of the world needs to step up and start paying some of the prices that we pay to subsidize the cost of research and development. The last thing, sorry to go on a rant, this ticks me off is just transparency. There is no transparency in the world. We should have public posting of prices for Medicare, Medicaid participants, plain English on rates and coverage and profits and claims and denials and wait times. All of that stuff is very, very possible. Unfortunately, you look at our system, and Doge uncovered a lot of this. We basically, the federal government is working like Blockbuster Video, and we need to get them up to speed, looking more like a Netflix or a streaming app. Um, and they're just not there yet. So it's possible. Unfortunately, you've got a lot of infighting on both sides. Neither side really refuses to cave. The House is absolutely useless because everything is so gerrymandered that if you're a Republican, you vote straight Republican. If you're a Democrat, you vote straight Democrat. You go back to your red or blue base. You don't have to answer for anything. They don't want you to work across party lines, so nobody does. House is useless. The Senate takes 60-40 to get anything done, which is impossible. You're not going to have that majority, so it's a bunch of executive orders by the president, whether it was Trump or Biden, which doesn't do anything long term. So easily fixable if we just had politicians which would act like adults. Sorry for the rant, but there's my answer.
I can't
Here,
add to that. That was good.
I don't know that I can add to that either. The next question for whomever wants to be brave enough to follow that is, I hear all of this stuff about diversification, but honestly, isn't it just better to buy an index fund and keep more money in cash?
I'll jump on that one. Yeah.
That was in your wheelhouse.
The only thing I'll say about the healthcare is health savings accounts. I have been told that if you are in the Obamacare healthcare.gov system, a lot of those plans now allow an HSA when they didn't allow it before. So maybe, if you're in that system, maybe go back and look to see if your plan allows an HSA when it didn't allow it before. The rules have changed a little bit there. So HSAs are amazing. So we can talk about it all day long. But yeah, diversification. So yeah, I understand that question. That's a very valid question. Why not buy the S&P 500 and then have some money in cash? I'm diversified, right? Well, first of all, the cash portion that you would have there is likely not keeping up with inflation. So you're losing purchasing power. And that's just, having a little bit of money in cash for emergencies is fine, but you don't want to have your long-term money there. I'll never forget when I used to work at a bank, and I would go and talk with people that had their money at the bank for years, and they would have their IRA in a CD, and I just want to pound my head, because this is money you're not going to need for 20 years, right? Because they were, in many cases, they were younger people, and so. Don't have your long-term money in cash. Don't have your long-term money in CDs. We could talk about that. Of course, we got to look at your risk tolerance. We got to make sure that you're able to handle the volatility. But certainly, I would say having an index fund, S&P 500 index fund, is a great investment. We actually have that in many of our models. But diversification, as has been talked about already tonight, can add a lot of value when the markets are choppy, and the large cap part of the market doesn't always win. Sometimes it does, sometimes it doesn't. You want to have a diversification there. So hope that helps.
Okay, I'm so sorry. My next one is, I am 55 and have worked for the same corporation for the last 24 years. They have decided to downsize executive roles, and I have been offered early retirement. My 401k is a little over 1.5, and I currently owe 232. My exit package is 200,000. What would be your advice right now in this market?
Mm-hmm. Wow. Thank you for the question, I'll say. But this is a great place to just kind of tee up financial planning. And I would say, I know that's probably like a canned answer you might expect to hear from a certified financial planner, but plugging all of your data in, are you married? Are you not married? You mentioned your age, but what are your goals? When do you want to retire? What is your comfort level with risk? Do you have other aspirations to maybe start something else at 55 years old? Do you want to retire at 60? These are just types of things that a meeting, we call it our discovery meeting, where we would go through all of that information, and we'd build out a plan for you, and show you, the current trajectory of where you're headed. And then we come back in our second meeting and show you what we would recommend. And sometimes we can improve your situation quite a bit. Sometimes we improve it a little, and sometimes we say, hey, you're doing everything right. But I would say, just for the sake of tonight's presentation, certainly you have options. You can roll assets over to an IRA. You can keep your assets there in your 401k. I didn't write down every detail of the question as I was hearing it. I should have, but certainly,
I've got it.
there are a lot of options there. Nick, do you have anything you'd like to add to that?
No, I think you nailed it. Everything is individualized and personal. So I'll let you, as the CFP, handle that one.
Okay.
Sweet. All right, the next question, and I have 2 or 3 more, but I'll try to be fast. But I think these are interesting. Thank you guys so much for sending these in. If the market is expensive right now, should I just wait until it comes down before investing?
I'll let Nick take that one.
Yeah, that was that slide that I showed at the end, which is, investing at an all-time high when the market is usually a little pricier has actually giving you better returns than investing at another time. And the problem with waiting, you could invest today, valuations are not cheap, and the market could drop 20% next week, and you're kicking yourself. Or you could hold off not investing and the market could go up another 40% from here, and you just never see that pullback. And maybe when we do see it, it's a 10% pullback, and now you've lost a ton of return. So no, usually you don't want to sit around and just wait for a pullback. Most of the time, the market's going to go higher, 80-90% of the time. And so you don't want to just sit and wait, or you're going to miss out on a ton of return. It's been proven. Um, the best thing is just put the whole lump sum in at once, diversify it properly, so that you're hedged. If you're not comfortable with that and you really want to take advantage of pullbacks, then just dollar cost average on a monthly basis or a quarterly basis, and then you will be able to invest at different levels. The market might be higher, you might miss out, market might be lower. But no, you don't want to sit and just wait. The market can be irrational for a very long time and continue going up higher than it probably should.
Yeah, that's a good answer. I would just remind people that if you miss the 10 best days in the market over the 20-year period, I think there's multiple studies that have done this, but over 20 years, you miss the 10 best days in the market, you basically cut your return in half. It's just really, really hard to know when to get in and when to get out. You see the market dip, and then you're trying to get in and it's gone up or it hasn't gone up. You just don't know. So if you miss those rebounds, you can really hurt yourself. So great answer. Dollar cost average if you're nervous, but getting in, just get in, diversified. One thing we do at Cannon Wealth, I'll let you know, is if you go in and you're diversified, let's say it's a 60-40 portfolio or an 80-20 portfolio, and you tell us, hey, next time we have a correction, give me a call, and we can maybe go from 60-40 to 80-20, or we can tweak. We'll put you on a list, and if the market drops by a certain percentage, we'll call you and just say, hey, you want us to make an adjustment now. But that way you're in, right? And you haven't missed out if the market just continues to climb. So good answer. Yeah.
We'll do one more, but I'll say this, which kind of shows our age. Matt and I, like well over 10 years ago, sometime during the last decade, but I think it was before, we had a speaker come in, and his main topic was volatility is not always a bad thing. And you have to kind of tell yourself that, just because the markets are volatile, that doesn't necessarily, it's not foreboding. So yes.
It can be an opportunity.
It is.
Yeah.
So last one, and then we'll wrap up. And I'm so glad someone asked this, because our particular niche, I feel like, is the fact that we work closely with Cannon and Company LLP, and they join us with several of these seminars. And I see that there are a couple of tax clients that are on here, and I really appreciate you joining in tonight. The last question that I'll do for the evening is, why does tax planning matter so much if I'm not rich? Which is a really great question for middle America people. So that's the one I'm going to leave you guys with.
Yeah, great question. It does. It's surprising how much it matters. When I first started in this industry back in 2004, I was not taught anything about taxes, and a lot of investment advisors get started in this business and they don't really learn about taxes. They learn the basics, like how you can shelter money in an IRA or 401k, but they don't learn all the nuances of the tax code to the level that you really need to know if you're going to use those rules to your advantage. And the laws are the laws. You can't change the laws. But if you know what they are, then you can certainly work within the playground and the sandbox that the government has given us. So I tell people, Social Security questions, that's a really big issue for retirees. How to avoid your Social Security becoming taxable. Required minimum distributions. How do you minimize that, because that can be a huge tax burden to you. Roth conversion strategies, when to do those, when not to do them. What about IRMA? You got to think about all these different things. Withdrawals push people into higher tax brackets. If you take money out in the wrong year. We just were meeting with a client not too long ago who did a strategy in their 401k where they had some stock in their 401k. And we recommended a strategy where they could take their stock out of their 401k and only pay tax on the basis and not pay tax on the gain until they sell it down the road. So things like that. I mean, that client, may not even have known about that. And so working with somebody who understands taxes can save you tens of thousands of dollars a year in some cases. We've seen it over and over again. It's important that your CPA and your financial advisor are talking. Anyway, you want to add anything to that, Nicholas?
No, I think that was perfect. Well said.
All right. Well, thank you, guys. We're a little bit after 7 here. Thank you so much for hanging in there with us. And we'll go ahead and sign off this evening. Really appreciate
just real quick. I will say, everyone here, I'm looking at the attendees. You'll be, and I'm sorry, I got to plug myself. You guys have plugged yourselves. I'm going to plug myself. Marketing, business development, client relations, that's all my wheelhouse. And so in March, you will be getting an invitation soon. It's going to be focused on the whammies of retirement planning. I think it might be showing my age a little bit because I showed Matt my invitation and he had no idea what no whammy, no whammy, no whammy meant. That's okay. It didn't hurt my feelings too much, but it's going to be basically from Chip and Matt, and it's going to be financial planning and how to avoid whammies as you are planning your retirement and as you are entering into your retirement. So look for those invitations. And yeah, guys, I think we did a really good job. Nick, thank you so much for pivoting on a dime. And I appreciate you joining us. And Matt, you're awesome.
Well, thank you. We appreciate our attendees. You guys are the real winners here to join on a snowy, icy night like this. And we will send out a replay. So be looking for an email that you can take that link and you can share it with a friend. Let us know how we can help. Thank you again, everybody. Have a great evening.
Stay safe.
Stay safe.
See y'all.